Welcome to American Dreams. My guest today is Brian Smedley. He's the chief economist at Guggenheim Partners. Brian, welcome to today's show.
Thanks, Alan. Great to be with you.
So, Brian, for the listeners to start out, can you tell us about what your current role at Guggenheim involves?
You bet. So I started at Guggenheim about 7 years ago, and I came on board to lead a team called Macroeconomic and Investment Research. And this team, in this role, I function as our chief economist as well. And we've got a team of 8 economists and strategists. And together, our objective is to develop a cohesive view of the economic policy and market outlook. And so we work closely with our investment teams. I report to our global chief investment officer, and we work closely with them to develop the house views, and then that those views are implemented across our investment portfolios. So it's a pretty broad remit across the 8 of us. We're looking at everything from the U.S. Treasury market to investment and investment grade and high yield bonds, commercial real estate, equities, FX, commodities, and pretty much everything in between.
So, what positions did you have previously that helped you prepare for this current role?
Yeah, so as I mentioned, I came to Guggenheim about 7 years ago, and before that, I spent some time on the policy side and then worked on the sell side. So let me just maybe just why don't I start with going back to college. I studied at Utah State. I was an economics and a finance major. Went to graduate school in Washington D.C. at GW. And when I finished my program there, I had some limited work experience. Had done some internships in D.C. at the White House for the President's Council of Economic Advisors, at the U.S. Treasury Department. But that was I was really looking to take my first full time job, and I ended up getting a position at the New York Fed. And so I started there in the Emerging Markets and International Affairs group as an economist covering Latin America. And then, after a couple of years, things really heated up in the U.S. with the emergence of the financial crisis, the failure of Bear Stearns in March of 2008. So shortly after that time, I had an opportunity to move to the open markets desk, the markets group, and that was run by Bill Dudley at the time. So in that role, I was covering foreign exchange markets, commodity markets, and then did some work sort of as a liaison to the buy side. So part of that effort was during the financial crisis to ensure that the Fed was reaching out to and getting feedback from the investor community globally to help make better policy decisions and be more informed on market developments. So all told, I spent about 4.5 years at the Fed. And then I left that role to go to Bank of America Merrill Lynch in 2010, where I worked for 5 years as a U.S. rates strategist. So my focus there was, really building on my time at the Fed, but my focus there was on the short end of the yield curve. So my group covered treasuries, interest rate derivatives like swaps and futures. I was very focused also on money markets. And this is all in the post financial crisis period, of course. So a lot of the the Volcker rule and a lot of the Basel framework and Dodd-Frank reforms to the banking system affected the money markets and the treasury market. So I did a lot of work on that in addition to, of course, watching the Fed closely. And so after 5 years of that, I've always been a big picture guy. I've always been kind of in search of a new learning curve. And so when the opportunity came up for me to move to the buy side and work at an investment firm like Guggenheim, it was a fantastic opportunity for me to pull together a lot of the things that I was interested in and try to complete the whole puzzle. And that's been a lot of fun.
So, who are the key people who helped you get to where you are today?
Yeah, there's so many people who've influenced me and who've played important roles in determining my path, really, that I'm so grateful for. I would start with my mom and dad. I grew up in the state of Utah and had two amazing parents, three older sisters and one younger brother. My parents were always super supportive of me and our family, and encouraged us to get a good education, to work hard, and really helped us believe that the sky was the limit. And so it started with that encouragement from my mom and dad. There was a time when I was in high school. Um, I graduated in 1998. I remember my dad's made kind of a, I was sitting down with my dad and he made a comment to me. He had just had a meeting with his financial advisor and he said to me, Brian, you should really think about a career in as a financial advisor in finance because the guy who works for me, he only works 4 days a week and he drives a nice car. And, that could be an interesting thing for you. So that kind of got the wheels turning. Anyway, so my dad in that moment, I went to college. I can think of another person, Madeline Timms, who was my finance advisor. I was a dual track economics and finance major, but my finance advisor made it, in a 30-minute conversation, made some recommendations to me that completely changed my life. And I think she was inspired. I'm so grateful for it. But she recommended that I go to graduate school in Washington, D.C., which hadn't really entered my mind. And so that opened up an entirely new career path for me. I would say, too, like in the workforce, my first boss, a guy named John Clark, an economist at the New York Fed, there was a moment, again, in early 2008, I had been working for John for a couple of years, covering Latin America, and they, the bank needed more resources in the markets group to cover, uh, financial crisis related things, staff the new lending facilities, cover market developments, and provide that intelligence to policymakers. And John came to me and said, there's this opportunity to go do a rotation in the markets group for 6 months. Would you be interested? And that again, that was another moment, a conversation that unlocked doors for me that I never could have imagined. One other person I'll mention is Haley Boski, who I work with at the Fed. She hired me onto her team at one point at the Fed, and then she subsequently left, and she played a key role in my decision to go to Bank of America, where she landed, and then ultimately to transition to Guggenheim as well.
Now, Brian, I understand you're also an accomplished musician. Did you ever wish that you would have chosen a career down that field of music?
Yeah, that's right. I am an amateur musician. When I was a teenager, I picked up the guitar at the age of 13. There was an old guitar my mom had bought for my dad for his birthday years before, and it was sitting in storage in my closet. And I thought one day, I should pick that up and start to fiddle with it. And I came to really develop a passion for playing the guitar, writing music, singing. And so as I got toward, graduation from high school, I actually thought, this is my passion. This is what I want to do. And so I applied to college as a guitar major, auditioned, and that was initially the way I thought I was going to go. But this was also during, the late 1990s. This was the heady days of the Nasdaq bubble. The stock market was on fire. The internet was new in terms of opening up, uh, you know, online trading, and so I opened up an online trading account. In my first semester, I switched to a finance major, and I left guitar pretty quickly. And I had so much fun just trading stocks, trying to identify patterns intraday in the computer lab at college. But I would say looking back on it now, I think I made the right decision in terms of, developing a career path that's I think more stable. It's been very, uh, enjoyable and very lucrative for me. But the other thing too that as I think about this, one of the challenges that I've had with music, as much as I love music and I love to play music and enjoy sitting down with the guitar, one of the things I always struggled with is when I'm trying to compose a song, which I don't do much anymore, and I try to compose lyrics, I struggle with the fact that there's not a right answer, right? And so I'm a perfectionist too. And so I'm my biggest critic. I'm coming up with a chord progression or lyrics or something, and it's easy for me to look at that and say, "Oh, somebody's this other song already, has already done that." And so what I love, I think about economics and finance is the market ultimately will bear out the truth of your decisions, right? Good or bad. And there is an objective function which is to optimize risk-adjusted returns. In the field of economics, it's about accurately forecasting the future and the implications. And so for me, it's a more comfortable place to be as somebody who's naturally inclined to be kind of a perfectionist, you know. So yeah, very happy here, but I do enjoy picking up the guitar now and then.
So, Brian, with I'm going to switch topics here, coming back to this economy with inflation at a 40-year high. What's your take on this economy? And as a follow up, how did we get here?
Yeah. It is extraordinary, Alan. Obviously, this is a situation with inflation we haven't seen in 40 years, and how we got here is very unique relative to that period in the 1970s. I would say, look, there are many factors on the supply side and on the demand side, but I would say, you know, just a thought experiment for our listeners. If you took Econ 101, um, basic economics understanding, think back to your supply and demand curves, and the demand curve slopes down, the supply curve slopes up. What happened through the pandemic is that we shifted the demand curve out and to the right, and we shifted the supply curve in and to the left. So what happens in that context is the price level goes up. Okay, and both curves I think have been in motion. So, you could go back to, of course, the fact that we have several effective vaccines that were started to be rolled out in late 2020 had a huge impact in the recovery. But also, of course, we had very, very aggressive fiscal and monetary stimulus. And part of the mistakes that, in hindsight, we did far too much on the fiscal and the monetary side. It wasn't that obvious at the time, and part of the reason is because economists, were looking back at the last 20 years of history, really 10 to 15 years in the United States, and even longer for Japan, and saying the cost of inflation being too low, of aggregate demand being too weak, are very high. It's hard. Japan has struggled for decades to get inflation up to 2%, and they've done huge fiscal stimulus, record monetary easing. And so, in the initial stages of the pandemic, it was critical the packages that were passed on a bipartisan basis. But in later 2020 and early 2021, I think that's when we overshot the mark, right as the vaccines were coming on board. And in the end, we dumped way too much stimulus on an economy that was already recovering. And that has really, um, look, I don't, just to point specifically to the Fed where I worked, many years ago. Jay Powell said in October of 2020 out to Congress and to the world that the costs of doing too little were greater than the costs of doing too much. That we could handle a situation where we overstimulated. So we are now living in a world where we have to clean up. The Fed specifically has to clean up the excessive demand impulse that we're living through. Now, it's also important to talk again about the supply side, and um, the there's a bunch of things from global supply chains to the energy crisis in Europe, brought on in large part by Russia's invasion of Ukraine, to zero COVID policy in China, which is gumming up supply chains and logistics. But another really important supply problem is around the labor market. We have too few workers in the US and in other parts of the world, most of the world, to meet the demand for goods and services. And we've been on this track in the United States for more than 2 decades. Um, it's been a process over many, many years that we've seen a deceleration in the growth rate of the working age population. We have an aging workforce. People are retiring pretty rapid pace. And so that's been exacerbated in the last 5 years by a big slowdown in immigration inflows, and we really are reliant on immigrant workers to help meet the needs of our economy, and also the pandemic. Tragically, many people have passed away from COVID or other complications, and other people have chosen to maybe retire or are sitting on the sidelines. And so we have a major labor supply crunch. Okay, so the problem here is that with the labor market extremely tight, that's putting upward pressure on wages, and that wage pressure is feeding through into underlying inflation. And then you layer on top of it the more, well, let's not use the word transitory, but the more exogenous um, factors, like what happened in new and used car market, right? What's happening with semiconductors, what's happening with energy and food. But the core of the problem, I think, is a shortage of workers. We also have a shortage of housing units. Right? We've been underbuilding housing for since really 2006 when, things peaked and we needed a period of time where we were, cutting back on new home construction clearly to absorb the overhang, but that's continued year after year. And so we've got a housing shortage as well.
Brian, there's a lot of individuals that are concerned, obviously, with all this change, the new economy and the labor shortage, the supply chain shortage, and they're looking for direction. As a professional forecaster, where do you think things are headed? Are there steps people can take now to prepare for the future? And if so, what would those steps be?
Yeah. Look, I would refer back to a recent speech given at the Jackson Hole Symposium, which was, just here in late August by Fed Chairman Jay Powell. There were other important papers, academic papers presented and speeches given by, ECB members and Bank of International Settlements. There was a common theme, which is grappling with this reality, the new reality of what we would call binding supply side constraints or a less, we transitioned from a period of supply side tailwinds, which helped keep inflation low, helped us keep, the economy humming along, and low interest rates for quite a few years, to now possibly more long-lasting supply headwinds, like we've talked about a few of those. And so the game plan as I see it, and I think this was essentially laid out by Chair Powell in his speech, is that the Federal Reserve has to take, again, they have to take responsibility to bring inflation down. They can't allow it to persist at high levels for a sustained period of time because then it becomes really self reinforcing. People embed that inflationary psychology into the decisions they make. Businesses do, households do, et cetera. And that makes it more persistent. And the Fed can't tolerate that. So, what is the game plan? As I think they're spelling out, the Federal Reserve is going to use their tools, raising interest rates, shrinking their balance sheet, using their guidance about the future path of the economy, about the future path of monetary policy. Those tools are intended to, what we say, tighten financial conditions, which is economists speak for make the stock market go down, make bond prices go down as interest rates rise, make credit spreads widen, affect confidence, investor confidence, consumer confidence, possibly bring, real estate prices down, certainly rental inflation the Fed wants to cool off, and push the dollar up. These are all part of the financial conditions channel of monetary policy. What is that supposed to do, right? The Fed can't affect the hiring decisions, the kind of pricing decisions that people make, but they can try to tilt the playing field so that people feel incentivized or disincentivized to hire and spend and invest. And so what they're going to try to do by essentially punishing the markets is going to, discourage people from spending, investing. The Fed needs to loosen the labor market, as they say, which means push the unemployment rate up. And the only way you can do that is you know, if you bring down aggregate demand so that businesses, employers, governments, reduce their demand for labor, maybe lay off some of their marginal workers. So basically, I painted a picture where the Fed is going to use its tools to essentially push the economy into a recession. They're careful about advertising that as the goal, but that has to be the solution. A period of restrictive monetary policy, tighter financial conditions, lower valuations for markets that will cool off this economy and hopefully bring inflation down so that it doesn't turn into a 15-year battle like happened from the late 1960s until the early 1980s. So so that's kind of the game plan as I see it. I think it's going to take several years for this to play out. In terms of what people can do, look, I think it's a time to, number one, get your financial house in order. Make a plan. That might mean developing a budget. From an investment standpoint, I think it certainly means looking for opportunities to de-risk. Traditionally, fixed income does well in an environment where we're heading into a recession. But again, we don't know how high the Fed is going to need to raise interest rates um, and what that may do for bond returns. But I think now is a time to to rein in a little bit of the optimism in terms of equity allocation, for example. And it's an this is a time to seek to avoid losing money, and I do think there will be great opportunities to invest at better valuations, but we have to see this process play out first. There was a question in the first half of the year because we saw GDP decline, that maybe we're already in a recession. Um, there's a phrase in Star Wars, where they say these are not the droids you're looking for. Um, they're trying to hide the droids, from in this example, this is not the recession you're looking for. Okay. We'll know it's a recession. We know the Fed is getting the job done when the unemployment rate is rising, right? And more recently, it's continued to fall. So as that process plays out, and as markets, if markets correct the way I'm describing, I do think there will be a great opportunity on the other side of this.
Brian, one last question. Okay, and I'm going off the economy. I want to talk about passion projects you're working for with in your spare time. Are you willing to share that with us?
Yeah, yeah. I mean, I'm one of those people, Alan. You may be the same. Where I've always got a thought going on in my head. There's always a narrative, something I'm thinking about, a project, and what I spend a lot of time thinking about and working on my spare time is, trying to develop tools to help me make better investment decisions. Obviously, my role at Guggenheim, that's a big part of what we do. We're monitoring the economy and the markets day to day, but we're also trying to develop kind of an infrastructure, a set of tools that we can use to guide our investment teams. I spend a lot of my own personal time thinking about how I can do better and be better in making my own investment decisions. How can I overcome my own cognitive biases that might lead me to, make bad investment decisions, which all of us face that. So what I'm spending a lot of time thinking about is developing, you know, a model, several models to help, make better decisions. That, for example, how do you build the most an optimal equity portfolio? How do you select, the different constituents of that portfolio? How do you weight them? How do you know when it's time to reduce your, market exposure or to add market exposure? So what we would call a systematic strategy is stuff that I find very exciting. I'm always looking for patterns, for models that I can apply that again, hopefully, in a way, kind of to help us see the future, right? Just how a meteorologist that's tracking a hurricane is going to use data and models and historical experience to try to predict the path and the implications of a major storm. In a sense, that's what I love doing, and thinking about how I can be a better investor is something that I'm very passionate about.
Well, Brian, I appreciate you being with us today on American Dreams.
Thanks, Alan. Great to be with you.